It's time now for today's strategy session. The flight to safety in full strain on Wall Street amid President Trump's tariffs. Just want to emphasize that if the S&P 500 closes at current levels, the S&P will officially be in a bear market. This is the second fastest plunge of the last 14 bear markets since 1945. So seeing just a hugely large sell-off in stocks here. I also want to mention we're seeing Treasury yields moving to the upside here, a bit of a sell-off in Treasuries as well. So we're going to talk about what that tells us about how the bond market is viewing the macroeconomic backdrop. Here with us now, we've got Chris Brigati. He is SWBC CIO, and Luis Alvarado, Wells Fargo Investment Institute Global Fixed Income Strategist. Luis, I got to start with you. What are we seeing in bonds right now? What is this telling us?
Yeah, bonds are pretty much a flight to safety, perceived safe haven. All this volatility in the equity markets is causing fixed income markets to perform well as investors move money away from equities and into high quality fixed income.
But why are yields up this morning? Why is the 10-year up 8 basis points right now?
Yeah, I would say yields are just a function of kind of the technicals, right? Investors moving money in and out. I don't take this immediate reaction. There's still plenty of trading during the day. And I think the story remains the same, right? The uncertainty around growth and uncertainty around inflation, uncertainty on what the Fed is going to be doing is causing investors to reshuffle money around. So not really concerned. Overall, yields have come down from the peaks that we got back in January and February. You're starting to see it down. And it's mostly obviously a reflection of investors kind of recalibrating those expectations.
Chris, what's the rule of thumb and the keys to asset allocation in turmoil like this?
Not to panic. You got to be really careful and really thoughtful about what you're trying to accomplish and keep the long-term perspective in play. And you should never get overreactive, positively or negatively, and just stay the course, so to speak, and be thoughtful about how you're going to proceed going forward.
And so when we talk about that course, I mean, your percentages of your portfolio that you should be making sure that you've got safe haven exposure while either maintaining long-term risk? I don't know, because that's what so many investors right now, when they're waking up this morning or having the brunch conversations with Maddie over the weekend, they're trying to figure out what is that good balance for me at this point where many people are clearly rebalancing.
You know, it's really tough for every individual to really define where they need to be, but the overall thought process and some of the conversations I've had lately have been along the lines of, should people be less involved in the equity market that they had been? They might have gotten overexposed because they were so happy with the returns. You know, 25+% returns 2 years in a row tends to draw people in. And I think that is part of the reasons why we're seeing some of the backtracking we are. People were overexposed, and a more balanced portfolio helps. And we're seeing that with what's happened in the bond market in the past few days as well.
Well, let's go back to you, Luis, on the bond market here. One of the things I'm wondering about is the degree to which the front end of the yield curve is yelling at central banks for help right now versus the longer end being a little bit more focused on the deficit. Can you talk to me about how the movement across the curve and a little bit of that 2's10 steepener that we've seen globally, what that message is signaling about the risks of policy right now?
Yeah, of course. The very short end of the curve is actually, flashing to the Fed that they need some help. We heard from Chair Powell on Friday, unfortunately, that the bar to cut interest rates further is quite high, right? He wants to see some of that hard data, translating from the soft data, hard data suffering, and he wants to see something on the unemployment rate, something on the inflation front. I know that some investors are probably kind of yelling out for the Fed to do more, to act more soon, but we don't think the Fed is going to do that. They're going to go ahead and wait. They're going to take a more pause measure and see how the situation continues to unfold before acting. On the long end of the curve, right, that's pretty much real rates coming down, the whole growth story moving, because a lot of Wall Street strategists coming into the year had a very good growth expectation, but now they have to recalibrate that growth. They're making some changes into first quarter, second quarter GDP. Some other strategies going all the way to the recession. We're not in that camp yet. We think that the economy has a good chance to recover in the second half, but that's definitely going to create some volatility. But again, the steepener that you've seen, to your point, between the 10s and 2s, obviously as the short end of the curve continues to fall more aggressively, kind of trying to push the Fed into some sort of reaction in the upcoming meetings.
Can it push the Fed into a reaction? As you know, the market's currently pricing in 5 rate cuts and an increased chance of a mid-meeting rate cut as well. I mean, can the bond vigilantes really get that done?
I doubt it. To be honest, I doubt it. We see a Fed that is going to be more cautious. It's going to be a Fed that's going to wait and see until this policies translate into sort of like economic evidence that something is happening, not just because equity markets sell off. We saw a really strong Chair Powell on Friday kind of pushing back on that idea that the Fed is not going to come to rescue the market by any time soon. They're going to wait and see until something really translates into the economy before acting. So I highly doubt it that they're going to go ahead and act as aggressive as Fed funds futures usually price in.
Chris, as we kind of put a pin in this, what is the best way to anticipate how the Fed, who was anticipated at one point to only have 2 cuts on the back half of this year, that is now anticipated to have 5 potential cuts this year, what is the best way to, in your portfolio, anticipate what the Fed might do in reaction to data, a data-dependent Fed that they have continued to pound the pavement saying that they are going to be? How can they make sure or how can investors make sure that they're not fighting the Fed, but best anticipating how the Fed may move towards that 5-cut reality?
Chair Powell has been really on his front foot with regard to telling people the path of the Fed. So you got to really listen to what he's saying and how he's approaching the markets. And what he said on Friday was a very passive approach, and they're waiting to see what will happen next, and not going to overreact to a market or the sentiments from President Trump either. So you have to really kind of pay very close attention to his messaging, and I think then you'll get a better decision. And ultimately, if you look at the predictability of the markets with regard to Fed rate cuts and the Fed's own inclination to predict, it's historically pretty poor. It does not reflect very well over a longer period of time. So if you're looking at a 6 months out rate cut environment, the market is usually very wrong in that regard. And we've seen that in the past. We saw that rate cuts were scheduled as high as 7 cuts at one point back in 3 years ago. Yeah. None of them happened.
So Chris, what's your single best idea for investors right now who are looking for something to do in this moment?
I think to go to more towards things that are a little bit able to weather the storm, and those could be consumer staples. I really like the energy, it's particularly utility markets. Long term, they do well in a recessionary or a downturn in the economy, and I expect them to fare fairly well. So this could be a buying opportunity for those types of stocks in this environment.
All right, a sobering reminder a moment ago, Chris, that the Fed's responsibility is not the stock markets. That is not part of their dual mandate. Chris and Louis, thanks so much for taking the time here with us. Appreciate it.